Mike, we did get a big rally last week, more than 4% for the S&P 500. Did that take away some of the excitement around the trade headlines that we got over the weekend?
Yeah, I think Sarah used up some of the fuel anyway, because you did have people coming into last week leaning very negative. You had those big air pockets around Thanksgiving. I think it unnerved people. So you're up more than 4% last week. I do think today represented a little more of a continuation of that kind of relaxation, essentially, of all these tensions. So it makes sense, up 1% on top of what we had. I do think, though, what you now have is the market enjoying the removal of trade as some kind of an imminent threat, the escalation of tariffs, the removal of any perception that the Fed was going to be, very determined to raise rates at all costs. You have oil prices trying to make a sense. So you have all these different strands of the correction that are working now in the bulls' favor. You have seasonals, too, which means, in theory, we have a better shot of getting above those levels from a month or two ago. But if the bulls can't make anything of it, then what does it say? And I think that's the kind of moment we're approaching.
Dennis, is this what you expected? And is it actually a trade deal?
Well, of course it's not a trade deal. But can I tell you, Sarah, remember I was here a few weeks ago, I said, well, I was super positive, but I also said, hey, let's remember that this is just a negotiation, and that when there are fruits of that negotiation, the market's going to rally. And of course, it's hard to say that these are ripe fruits, but they are indeed some signs of some progress. And look, does it make a difference whether we actually send cars from the United States to China? No, it does not. Do I think that Bob Lighthizer, who is going to be leading the trade negotiations, is going to drive a tough bargain? I do. Do I think personally that that's good for the U.S. economy and the U.S. negotiating stance? I do.
Okay, but one more. Do you think that China can change its industrial policy and intellectual property rules in 90 days?
No, but as its GDP continues to rise, both as an absolute number and on a per capita level, it's going to have to play by the rules, which it has not done over the last 17 years since WTO.
Mike, I know we had a decent week last week, which you've already pointed to, but when we consider the Fed has changed its tone last week, the market wanted that. We've got a China trade truce, the market wanted that. Oil has stabilized. Would we not have expected a more decisive rally today?
I don't know about expected. Certainly you had the makings for something better. I do think, if I looked at kind of inside the market, it was not an overwhelmingly bullish day. It was perfectly fine. You had, 2-to-1 up versus down stocks. All those signs you look for to say, was this a renewed, urgent buying frenzy today? No. It was a continuation of just getting stocks marked up to levels that seem to match up with where we are fundamentally. I do think the credit markets were okay today. That's one element of what's been bothering the markets that has not fully confirmed the recovery in stock prices.
But something interesting happened in the bond market that Rick Santelli pointed out last hour. We got an inversion in the yield curve. The spread between 3- and 5-year yields going down to negative 0.6. So that's the first time we've seen that since 2007. Are you worried about it?
Well, of course, the old saw is that an inverted yield curve is as a precursor to recession. So that's something to pay attention to. But then again, we're at a period where the Fed's been raising rates at a pretty healthy clip. So it doesn't seem out of bounds to me for there to be some of those dislocations in the way we're seeing that may not be directly reflective of a recession. But we were coming out of such an anomalous period that when we're moving rates up, that we might see.
It's also not the 2s, 10s, I should note, which is sort of a caveat.
Not the most widely watched game.
But the 1s, 10s did fall below 30 basis points, first time since 2007 too. So something to keep an eye on. Let's talk tech though. Tech stocks started the month higher, getting a reprieve after the US and China reached a trade truce. All FANG names finished in positive territory. So it's the worst over for tech. I'll also just point out that Amazon overtook Microsoft in market value at the close, just $1 billion behind Apple, which overtook the two of them, having fallen behind Microsoft last week. The three of them fighting it out to be the biggest in the world. Understandable to get a bounce, but quite a big bounce when you look at some of the chip stocks. Apple itself, a big game.
I do think it makes sense just in terms of the velocity of those declines that a lot of those stocks, it's particularly Apple. It certainly wasn't down mainly on trade fears, but you would have maybe even expected a better bounce in Apple. So, I think there's two ways to look at it. One is it's an obvious place for dip buyers to go back and start to just, buy the high quality companies that are trading somewhat on sale. But it's not necessarily a resounding, aside from Amazon, which has the tailwind of what's almost certainly going to be a strong holiday shopping season. it was just, to me, it was kind of mechanical bounce today.
I mean, AMD went up 11.3%.
Yeah. Well, the semis is right there, right front and center in terms of what's potentially was going to be a big victim of the trade flows. That's not the case right now.
Is tech where you want to be?
Well, it depends which tech, but let's just talk about Facebook for a moment. And again, just speaking generally, if you look at a 19 times multiple forward earnings, is that too rich for a company that grew 40% last year? Grow certainly not at that rate in 2019, but keep on growing. I think it's worthy of looking. When you look at some of the multiples across, say, the S&P 500, that is not a multiple that's out of bounds by any stretch. If you look at a Netflix multiple, I think trading 70s or 80 times forward earnings. So there are a lot of questions for a lot of these FANGs, but I don't think they've been definitively knocked out at this point.